Hi everybody, it's Thomas with the first quarter market summary. There is a lot to talk about, so let's get started. All my contact info is on the slide, and if you know someone that might need help during this volatile period, you're welcome to forward the video, share the link, or share my contact information. Before we go to the charts and the summary of the quarter, I wanted to update where we are as of today. I think I sent an update on the 9th, and so we're a week later than that. Here's the chart, and the rally that we've seen start from the lows has endured. And let's just take a look real quick. That box down at the bottom is the data box, and hopefully it's big enough for you to see. And I'm on the left, I'm highlighting the very beginning of the year. So from the start of the year, the market's down 32%. The box has 81 days, which are calendar days, 57 bars, which are weekdays or trading days, down 32% and down 103 points. And then it's got to angle the degrees that the angle is at. So down 32% on the year. What everybody's always referring to in the news is from the highs. So we were up a little bit in 2020, and we're down 35% from the highs. And while I've got this bottom and top, if we slide over, it starts to calculate instead of losses. If we rally, you can see the data box shows we've got to go up. It's the same number of points, about 120 points we have to rally, but since the number on the left is 340 approximately, and the number on the at the bottom is around 220, to get 120 points, you've got to make 55% instead of 35%. That's why it's so important and so helpful for long-term returns to lose less when the market goes down. And if we basically, I'd have to do some math to figure out, but let's say instead of ending up down here, your portfolio is a little bit better, it's going to be able to get back to, it's not going to take so long to get back to even or get back to up on the year, because you're starting. And so you really should have you should outperform going forward, by a consistent amount based on what you've saved. So let's get rid of these. And this rally has gone up almost 31% now as of, there was a big gap up today, 600 or 700 Dow points. As you know, there's tons of stimulus and people are looking out further ahead past the current bad news, and they're looking at better times ahead. So it is what it is. Prices have rallied. That's good for almost everybody. And again, we've got to go quite a ways to get back to even. Let's do from the current price, we only have to go up about 12% more to be up on the year, which is incredible after being down so much. So that's all I want to say about that. Let's get back and start looking at first real quick. I think I've shared this slide, and if you go along the top line, this is the firm performance. That's all the money we manage in the ending market value. This is the deposits and new clients. This is the money that the whole firm, all clients aggregated together, lost so far. That's the percent decline that we've had. And we know that our equities aren't down as much, but when I wrote this, we were down about 20% still on the year at the end of the quarter. So we're outperforming by a large amount. The benchmark for the firm is down, and that's the outperformance. And most clients that have been with me for a long time know that during declines, we tend to outperform because we're hedging. We also, even though we're hedging in 2019 for various reasons, we actually outperformed 19. And since inception in 2003, we're ahead of our benchmarks, which is very unusual. And this slide kind of describes that. We're not a mutual fund, but I would say these are mutual funds that are being measured. And for a 10-year period, there's 3,000 funds. Most people don't know how many funds typically just go away. They fail, lose investors, and just close shop. So about 40% over a 10-year period are gone. and only 21% beat their benchmarks. And it's kind of consistent throughout 15-year and 20-year periods. We're in our 17th year, so we're in this category, and only about 18% ever beat their benchmarks, so we're in good company. This is a slide I don't think people have seen before that just gives perspective about bull markets and bear markets. And if you look at the details, the bull markets are in blue, the bear markets are in red, the years are down here below. And it's interesting, and I'm going to leave it to you to take a look at the individual data points, but it's looking at the duration of the bull markets and the return for the bull markets. And it helps explain why you have to try to stay in your seat, not time, get in, out of the market. But if you stay in your seat, the returns on bull markets are much greater than the pain we endure when there's a bear market. This is the same data, just with a 20-year period, a 20% decline, I mean. So this is the slide we usually look at. This is the quarter, and of course it was ugly. These are the types of investments across the top, from US, developed, foreign, emerging markets, undeveloped, foreign, real estate, and bonds. And everything was down but bonds. This is similar to the bond returns we got for people that were in the whole quarter. And then again, down here is what I really love, which is context, which is these are the returns for the quarter. These are the average returns. So you can see how far out of normal we are, out of average we are. And then for context, it lets you see what's the best quarter and the worst quarter. So for the US market, we almost, but didn't quite beat the terrible quarter in the fourth quarter of 08, but we came close. We did set a new record. So we've got a 2020 first quarter, they're number one. And in emerging markets, still didn't beat fourth quarter of 08. And bad returns across all categories. This takes, since what we were just looking at was only a 3-month, the previous slide was just the quarter. Now we're looking at 1, 5, and 10-year periods. And this is also helpful because 1-year periods are tremendously volatile with gains that are huge gains in some years, huge losses in other years. It smooths out over the 5-year period. And the average return is in US markets, which is going through a really good period lately relative to the other markets, it's got positive returns. And of course, bonds over long term have great returns, but they're low. And then 10-year returns across all categories are positive. Kind of explains why we invest. This is the news down below in text and a graph of the market price. And this was interesting. I think I touched on this before about every Thursday, the unemployment comes out, and we've had 5 or 6 million unemployed for 3 weeks in a row. But the market's gone up every day that all this bad news has come out. And again, I keep saying price is disconnected, and it doesn't correlate in time. Price doesn't correlate with the news. Investors are looking very, very far ahead. It doesn't mean they're right, but that's what they're doing. They're expecting better times ahead. We could, of course, the news could get bad, new information comes in, changes investors' minds, so we could go lower, but this rally has been much stronger than people anticipated. This is the same type of graph over a 12-month period, and it's got the news at the bottom and the chart of prices on the top. And this is a ugly view. The only thing up out of all the world asset classes, the different types of investments, only bonds were up, and the US did the best with an almost 20% decline, and so everybody was way worse, which is surprising. So foreign and small cap, this is US large cap, everything else did worse. In US stocks, big companies are a little safer than small companies, so small companies really took a hit. It's easy to think how undercapitalized or small companies might, a larger percent might go bankrupt during this quarantine period. It's the same story in the developed foreign stocks like Europe and other developed countries. Growth was the least bad, and small and value were the worst. And this is countries. On the left are developed countries, and I've highlighted the US, and we're in about the top third, and some incredibly ugly returns for a single quarter, where Austria lost 40% almost of its market value. And in the developing emerging markets, things were even worse with higher losses. That is the end, and this is the typical editorial from DFA, and it's basically saying to use a system and a philosophy that has worked in the past. It's not just enough to just stay the course. You've got to rebalance. You've got to do the things. You got to have low expenses. You got to have a plan, and you have to have the emotional strength to carry out that plan. That is it. If anybody has any questions, they're welcome to call me anytime. And again, there's my contact info. For clients, reports will be going out probably today, and I'll be getting in touch with most of you in the coming weeks. Alrighty, thanks a lot. Bye-bye.